Hey guys, I just wanted to touch on a few things real quick. I'm looking at the top stories in Bitcoin. I'm sure you guys might check this stuff out, but I just want to go over a couple of these headings here, and then there's an article I want to show you on the SEC. That's the point of this video. Making sense of crypto assets valuation insanity. Bitcoin's next future expiration is this Wednesday. So you know what? That means Wall Street. Wall Street is hoping to make money on the losses. Okay, Bitcoin rises modestly against or after recent slump. So there's some new stuff out there. If you want to look up Bitcoin, just Google Bitcoin. But there's something I really want to show you. If I could find it now. I had it earlier. Where the heck was it? It was the SEC article. And I started doing a video, and then I ended up doing a vlog instead. But this article, I'm going to pause this real fast, and when I find it, I'll be right back. Alright guys, I found it. It's ICOs. Fix the problem before the SEC fixes it for you. Alright, I just want to go through this real quick with you. There has been apparently significant shock and surprise over recent reports that the Securities and Exchange Commission has issued a large number of subpoenas to initial coin offering issuers and the ICO gatekeepers who may have been involved in token transactions that potentially did not comply with federal security laws. To a large extent, this shock and surprise is shocking and surprising. The SEC has been as clear as it knows how to be that virtually all tokens and simple agreements for future tokens and SAFTs are securities for purposes of the federal securities laws. It is true that the SEC initial forays into the crypto space were comparatively gentle. Instead of bringing an enforcement action in the DAO case, the SEC instead opted to issue a report. The SEC also simply told Munchie Inc. to stop its unregistered token offering. Wow, it's been a long night. And did not bring any further actions against it. Some participants in the crypto community apparently mistook this action as suggesting that the SEC would continue to be gentle, perhaps by essentially grandfathering pre-existent token sales, regardless of their lack of compliance with the federal security laws, or by pursuing only the most egregious violations of federal security laws, such as those involving token issuers engaging in garden variety fraud. That was an unfortunate misreading of clear signals that the SEC intended to send. Unsubtle hints. The SEC Chairman Jay Clayton's repeated statements that virtually all token offerings are securities, for example, should have been clear signal to the market about what was likely to happen. The fact that SEC had created a cryptocurrency task force headed by members of its Division of Enforcement should have been another. The SEC is very clear in those few times when it says it may not fully prosecute prior security laws violations. A good example of how SEC tends to approach those instances was in the recent offer to investment advisors with potential fiduciary duties violations in connection with mutual fund share class selections to voluntarily discuss those violations with the SEC. Obviously, the SEC did not make a comparable offer to the participants in the crypto community who may not have complied with federal security laws. In any event, the crypto community is now on full notice that the SEC will focus on prior token and SAFT offerings that did not comply with federal security laws, and it can generally seek disgorgement and money penalties for such misconduct that occurred within the last 5 years. The SEC will insist that all token issuers comply with applicable federal security laws as they develop their platforms and token markets. The good news is that none of this means that cryptocurrencies and platforms cannot operate in the U.S. They can, but they need to do so in compliance with the federal security laws and other applicable laws and regulations. There also should be no longer There also should no longer be confusion about what the SEC thinks. The SEC thinks that virtually all tokens are securities, and it thinks that all applicable security laws, rules, and regulations apply to tokens and token platforms. This is, after all, precisely what SEC Chairman Clayton and the other SEC have been saying. How to respond? Token issuers could, of course, take SEC or private litigants to court, and it's possible that at least some courts would determine that at least some tokens are not securities. In the ordinary case, though, the issuer may first have to move through years of expensive litigation with the SEC or private plaintiffs, during which time it may be difficult to fully operate the platform due to litigation risk and market uncertainty. It also is worth considering that many courts may well agree with the SEC's position. I mean, you're going against the government, guys. Who do you think they're going to take? You're going against the government, and the government's going to decide the position. So, who do you think is going to win that? It's obvious. Moreover, even if one token issuer is successfully in persuading a court that the tokens are not securities, other token issuers may not find much to celebrate. The determination of whether a particular token is a security is likely to be high fact specific. So the fact that one token is not a security may not be much help to tokens with significantly different characteristics. Accordingly, here is what we think a few key takeaways of the observation following the SEC's reported recent actions. Tokens are almost always securities. The SEC will treat virtually all tokens as securities. The token issuer should treat their tokens as securities. Okay? Utility token does not mean what you think it means. The SEC believes that tokens that have or will have utility generally are still securities. Legal or other opinions that token is a utility security and therefore is not a security are unlikely to be persuasive to the SEC. A token does not stop being a security when the related platform becomes operational. This is a corollary. Wow, why do they use these words? Seriously. This is a corollary to the fact that utility tokens often are still securities. Whether or when a token stops being a security is a highly fact-specific question, which likely turns on factors like continuing degree of involvement of one or more platform sponsors in the token ecosystem, and whether the tokens are largely being purchased and held for consumptive purposes or for investment purposes. None of these have any likely correlation to the time a token platform becomes operational. Okay? You can't add your way out of a token being a security. Whether a token or any other instrument is a security is based on statutory provisions and many decades of carefully crafted court and SEC decisions. None of those provisions or decisions rely on assigning numerical values to various factors and adding them together to try to reach a target score. While some token issuers have tried to rely on the purported tests that use such mathematical approach, the SEC likely will not be persuaded that such a numerical exercise is useful to the analysts of whether the token is a security. Okay, so technically and technological distinctions between tokens generally are not relevant to the question of whether a token is security. For example, there is no difference in the analysis of whether a protocol layer token and an application layer token is a security. The differences between the two may be very significant for some purposes, but both are likely to be securities to the SEC. Similarly, distinctions between and among terms like coins, tokens, and currencies may have important distinctions in some contexts. There is no distinction in the analysis of whether they are securities. Is your token really that different from the other tokens? Well, for those tokens issuers that still want to argue that their token are not securities, you may want to ask yourself this. If the SEC thinks that each of the hundreds of thousands of tokens it has seen are securities, what are the fundamental differences between your token and all the others that make your token the only one that is not a security? Do you really want to risk an enforcement action and potential token holder litigation on that distinction? Fix the problem before the SEC fixes you. And that's the title of this article, guys. If you have sold tokens to an unaccredited investors, or if you have otherwise not complied with the federal securities laws, strongly consider fixing the problem before the SEC finds you. Potential approaches include doing a rescission offer, forking or burning certain tokens, and self-reporting to the SEC. All of these are unpalatable, to be sure. Having the SEC show up at your doorstep likely will even be more unpalatable, especially if you have not taken steps to address known security law violations. How do you offer tokens in the U.S. if they are securities? Assuming a token or a SAFT issuer is selling in a private placement, the issuer should sell only to accredited investors that have been verified as accredited, and should sell to tokens and SAFT only pursuant to a tailored disclosure document and risk factors. White papers, while helpful, typically do not include many of the disclosures and risk factors that should be included in a well-structured private placement. Issuer also should consider conducting AML, KYC, and similar checks. Okay, KYC is know your client. Must conduct OFAC reviews and must consider the applicability of various state laws and regulations. How do you make a token freely tradable and available to retail investors? If a token issuer has sold tokens in a private placement, the holders of the tokens generally may not resell them, and retail investors generally cannot purchase them. To address these limitations, many token issuers likely will consider one of the three options: registering the token in a traditional initial public offering, qualifying the tokens under Regulation A+, or waiting a year when the tokens may become freely tradable if certain conditions are met. There are significant pros and also significant cons to each of these options. Crystal clear. There has been legitimate confusion in the crypto community until now on whether, when, and how the federal securities laws apply to token and SAFT offerings. There have been an extraordinary range of advice from numerous lawyers, law firms, and others, and many ICO issuers may not have had a ready way to determine which advice was sound, which was dangerous, and perhaps which was overly cautious. That confusion is now largely gone. For token issuers that have already made offerings that do not comply with the federal securities laws, for token consultants and distributors that may have been acting as unregistered brokers, dealers, and for trading markets that have been acting as unregistered exchanges, it's time to address these issues. Going forward, many token issuers will undoubtedly find that the federal securities laws, as applied to the tokens and token platforms, are clunky and cumbersome, and not well tailored to their activities. Registration statement forms were not developed with tokens in the blockchain in mind. Periodic reporting requirements were not developed with ICO issuers and platforms as the reporting parties in mind. The securities trading rules were not developed with token platforms in mind. The regulations governing security exchanges and markets were not developed with cryptocurrency in mind. Nonetheless, the federal security laws still apply. In the short term, ICO issuers and their counsel can work with the SEC to attempt to tailor existing registrations, reporting, trading, and exchange rules to better reflect the nature of the token and token platforms. In the longer term, the crypto industry perhaps can work with the SEC, other regulators, and Congress to develop a modified registration, reporting, and trading system that is designed specifically for cryptocurrency. So there you go, guys. That is the latest from the SEC. And there's other articles out there, too, from the SEC right now. I just saw SEC to Bitcoin investors, you should demand regulation. So just go in and, into Google and search Bitcoin and then put a space and then SEC, and you'll see these articles, guys. And this is something to pay attention to because this is going to affect all of us. All right, have a good day.